Well, hi there. My name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, Happy New Year and thank you for taking the time to watch our Portfolio Manager's Brief for January 2020. Well, there was very little holding the U.S. and Canadian stock markets back in December. We had identified a possible headwind with a proposed round of tariffs set to take effect on December 15th. However, with a Phase 1 trade agreement reached between the U.S. and China instead, and Trump's impeachment being of no consequence to the markets as anticipated, investor optimism continued to push stocks higher into the close of 2019. Much of this optimism was and continues to be supported on several fronts. Monetary policy continues to be accommodative, which keeps money cheap, in turn supporting business growth and development, corporate share buybacks, and consumer spending. A strong labor market and global wage growth, along with healthy household balance sheets, again supporting consumer spending and fostering general investor optimism, as well as what appears to be a stabilization and even potential increase in projections for global trade, manufacturing, and overall growth, which should bode well for further foreign investment both in Canada and emerging markets where earnings revisions have already begun to trend higher. Altogether, these are considered to be signs pointing towards what should be another positive, albeit modest year of growth for global markets. So what are the risks? Well, as we have learned, investors and subsequently the stock market can be influenced by headlines, especially when company valuations are stretched and markets are at all-time highs. While the ongoing U.S.-China trade negotiations appear to have made some progress, as we've seen in the past, anything can happen, and another round of tariffs could certainly slow things down. The recent escalating issue between the U.S. and Iran regarding the Trump-ordered assassination of Iranian Guard Commander Soleimani initially caused significant pressure in the overnight futures markets. However, this potential confrontation was quickly discounted as immaterial to the current uptrend as Iran's military response was limited and both sides seemed to have de-escalated. Nonetheless, if these actions strain relationships in the Middle East further, the knock-on effects on energy prices and trade may factor into capital spending plans for many companies, slowing global growth expectations down. With U.S. and Canadian stock markets beginning 2020 at all-time highs, company valuations are stretched, meaning that share prices are expensive, which begs the question as to whether or not the markets have gotten a little ahead of themselves. While a moderate pullback is a growing probability in the short term, since markets never move in a straight line, we are watching to see how this latest round of corporate earnings go. In order to support current valuations and further growth, we need to see earnings revisions to the upside. This would be a contrast to much of what we heard in the early part of 2019 and suggests companies are considering better days to come. This leaves us with the political wildcard in the U.S. As we mentioned last month, the prospect of a Democratic White House could certainly have a negative impact on stocks as the election process unfolds. And with the recent tensions between the U.S. and Iran, one can't discount the possibility that Trump will look to keep the heat on, as the threat of war could go a long way towards securing his commander-in-chief position for another term. Based on our continuing analysis of market risk and opportunity, we are set to remain actively defensive in managing assets through the first quarter of 2020. This means we will continue to be selective in which companies we invest in, actively taking profits and cutting losses, and ensuring we have cash on hand to take advantage of the pullbacks. As earnings revisions adjust higher and evidence of a turnaround in global growth continues to be supported by the economic indicators, we will also look to expand our exposure into the emerging markets and other EAFE investments outside of North America. And finally, we are excited to announce the January launch of our Alternative Strategies Fund and its addition to our 3-pool mandates, which is allowing us to diversify our approach to the markets with a focus on more sophisticated, tactical, bullish and bearish option strategies to help us enhance returns and reduce overall portfolio volatility.